Holistaplan presents Tax Time with Jeff Levine. Let's talk taxes.
Hello everyone, Jeff Levine here, and it is awesome to be back with you. With our time together today, I thought I'd spend a little bit of time talking about some of the unique aspects of the child tax credit for 2021 and why it's different from some previous years. We'll start with the amount. Over the past few years, the child tax credit has generally been $2,000 per year, and that was changed as part of the Tax Cut and Jobs Act back in 2017, first effective for 2018. It used to be $1,000 per child. It was raised to $2,000 per child under that law. Well, interestingly enough, those dollar amounts are even higher for 2021. Specifically, most children will qualify for a $3,000 per child credit. Obviously, the children don't get it, the parents do for claiming those children. But there's even a higher credit amount for children who are under the age of 6 throughout the entire year. So those who are still 5 or under at the end of this year can get a $3,600 per child credit. And all the child has to do is be born this year. So if we're looking at someone who was born even December 31st, that child would qualify for the full credit this year. There's no prorating of that. The second nuance to the child tax credit that you want to be aware of for 2021 is that whereas normally the credit only goes through age 16, this year it is through age 17 as well. So 17-year-olds qualify for this credit as long as they're not 18 or older by the end of this year. They are still good. The third key thing that you want to be aware of with respect to the child tax credit for this year is that there are actually two separate phase-out amounts, two separate phase-out ranges. The enhanced credit amounts, so the amounts in excess of $2,000. So for older children, that's $1,000, the difference between $3,000 credit this year and $2,000. For those younger children, it's $1,600. For children and the enhanced credit, those enhanced credits begin to phase out as income exceeds $150,000 of adjusted gross income for married couples filing joint returns, and half of that for single filers. Whereas the base credit, if you will, the $2,000 credit amount, well, that credit amount doesn't phase out until $400,000 of AGI for married couples filing a joint return and $200,000 of AGI for single filers. So much higher phase-out amounts for the regular credit, which in and itself is already enhanced from the $1,000 it was before the Tax Cut and Jobs Act. But then a lower phase-out range for the amount in excess of $2,000. The fourth key thing I want you to be aware of is that the child tax credit this year is fully refundable. It is fully refundable. So that is an important change for a lot of families. They may actually, by virtue of this child tax credit and other changes, may get more money back from the federal government than they actually paid in throughout the year. And then finally, it's worth noting that beginning in July of this year, the IRS began making payments to individuals of their estimated child tax credit for this year. Now, this is really important for advisors to understand to help their clients, because maybe clients have had substantial changes in income from previous years to this year, etc. Maybe that advanced payment of the credit is too high. Well, in most instances, there will be a recapture of that prepaid credit on an individual's tax return when they file next year. That's something clients might want to know. Now, how do you spot this? Well, best way to do so is with tax software, such as Holistaplan. And so with that in mind, I want to turn it over to my good friend Ben Birkin, who is going to share with us a little bit about how Holistaplan can help you identify the size of the child tax credit that a client is eligible for, as well as where clients may need to be careful about having to potentially repay these prepaid amounts. And if, in fact, you find out that the client will have to repay amounts next year, you can contact the IRS now on their website and ask them to stop sending those payments in advance. So strongly suggest you take a look at that. And, of course, this bit of information from my good pal, Ben. Ben, over to you.
Thank you, Jeff. Ben Birkin, Vice President for Customer Success and Engagement here at Holistiplan. And I wanted to use our scenario analysis tool to talk a little bit about what Jeff was talking about with regards to the new child tax credit situations for 2021. So I'm already in the scenario analysis tool. I've pre-built a couple of scenarios that I think will help illustrate some of the concepts that Jeff was talking about, because not only do we have just a higher credit amount, but we've now got two different levels of this child tax credit, the regular one and the enhanced one, or whatever it is that we're calling it these days. So in my first scenario here, in scenario one, I've got a baseline scenario with a wage amount for this married filing joint couple of $120,000, a few other items, interest and things like that, but I intentionally built it so that their adjusted gross income is below $150,000 so that we can see both the enhanced and the higher credits as it relates to where those things might phase out. Important within the Holistiplan system, you have the opportunity to change not only filing status, but dependents and dependents available for credits, because there's also this credit for folks under 6. It's a little bit higher. In this case, we've got a family of 4, married filing joint with 2 total dependents that are between the ages of 6 and 17 for the 2021 tax credit. We scroll down, we can see in the refundable credit section that we've got a calculated refundable child tax credit of $6,000. If you were comparing this to a scenario from 2020 or a return from 2020, you'd note that there would have been a child tax credit up here that's now gone, right? Because that child tax credit has moved from the non-refundable section down to the refundable section. Now, it's important to realize, as Jeff was talking about, we've got a couple of different phase outs to be mindful of. So if I click over to the range calc screen for this particular scenario, which I've got on another tab here, can see that not only is range calc going to tell me where I'm going to see changes in marginal tax rates, that's what you see in these blue sections, but these gray sections are also going to show me where the phase outs start and stop for the refundable child tax credit, both for the enhanced and for the higher level one. So here with this particular scenario, there's not really much room to go before we start coming in on that 150,000 adjusted gross income number, and we start phasing out the refundable child tax credit on the enhanced side. And in fact, that's what you see in this second scenario. So here I've said they've got higher wages by about $20,000. That bumps them up to an adjusted gross income of $163,000, almost $164,000. Holistiplan will automatically calculate the reduced child tax credit for you. You can see that by having $20,000 more in wages, we're knocking out about $700 from that credit, which, if you think about it, that's why you see this higher marginal amount. By adding additional ordinary income, you're not just increasing the amount that's subject to taxes at that 22% rate, but you're knocking out credits in that 5% rate. So you have this effective rate of about 27% if you just added $12,000 to this person's income. You can see the same thing at this higher level, although you have to work a lot harder to get there, right? Because we've got a much higher adjusted gross income level, but you see the same level of phasing out until the point where it phases out completely. Hopefully you found this helpful. We want you to be a good tax planning hero for your clients, especially when it comes to making sure that they're eligible for credits to the extent that you can keep them that way. Thank you so much for watching. We'll see you next time.